AI spending is in the spotlight again after SoftBank slides on its sale of Nvidia stock. SoftBank fell as much as 10% in trading in Tokyo earlier after it sold a $5.8 billion stake in Nvidia to help finance its vast investment in OpenAI. It has committed at least $41 billion in AI-focused investments and purchases, including a $22.5 billion follow-on investment in the ChatGPT creator. That's led to wider market nerves again about the massive spending on AI infrastructure and how much of it is being funded by debt. Joachim Klement is head of strategy at Panmure Liberum. Joachim, selling a massive stake in highly profitable Nvidia to buy OpenAI seems like an example of a risky mood in markets, doesn't it?
Well, you could also call it profit taking in a stock that has done extremely well. But I completely agree with you. The main concern these days about the AI investment boom is how much debt is there and how much is actually visible. And clearly, there's a lot of debt under the surface that is not necessarily held on the balance sheets of a lot of these companies.
Yes, we did think until recently that most of this huge build-out was being financed by hyperscalers with money that they had on hand. That seems to be less and less the case, doesn't it? Even big names like Meta and Alphabet are issuing more debt to pay for this.
Absolutely. And they're increasingly outsourcing that into special purpose vehicles where they go into joint ventures with other investors to offload that debt off their balance sheets, but still being able to recognize any profits that they're making from that on their P&L.
Is the market then waking up to the fact that massive AI spending is too reliant on debt?
It is. We've seen after the last earnings season that just ended how analyst expectations for future investments in AI have been downgraded by about 10% over the last 4 weeks. So there is a little bit of sanity coming back into the market. But we also have to be aware that, in my view, the AI investment boom is not yet in a bubble and can still inflate somewhat further, particularly if the Federal Reserve continues to cut interest rates aggressively.
Inflate somewhat further? What are you expecting then once those rate cuts come?
Well, those rate cuts can easily get in AI investments from currently $350 billion per year to $500 billion per year in a couple of years' time, particularly if the Fed cuts interest rates more aggressively. The problem is that this kind of investment boom in AI literally crowds out all the other investments that need to be made in the US business world, whether it is infrastructure investments or other business investments in factories, machinery, etc.
What about the circularity of many of these deals, especially OpenAI's with its investors and chip makers? How worried should traders be about that?
It's an old way to kind of inflate your revenues by basically giving a company money that they can then use to buy your products. I think at the moment, this is a rather small part of the problem. It is probably bigger for a company like OpenAI, which is trying to kind of make itself look bigger than it actually is. But for the big listed hyperscalers like Microsoft, Meta, and Alphabet, I don't think it is a real problem.
What could pop the AI bubble then? What triggers should we be thinking of?
It's a very, very difficult question to ask and to answer because I don't think that AI is in a bubble that is ready to pop immediately. It can easily go on for another 1 or 2 years. Effectively, I think the most likely candidate is if we start to see a slowdown in the growth expectations for the revenues. At the moment, AI companies and hyperscalers are, as I said, investing several $100 billion per year, but the revenues from AI are in the order of $20 to $50 billion. If that imbalance doesn't close and doesn't change in the next 1, 2, 3 years, then I think that disappointment could pop. That boom.
How willing are investors then to keep buying this sort of debt in the short term?
For now, I think there's a lot of willingness by investors to continue to buy this debt, especially with the perspective of future rate cuts, which could lower bond yields and create attractive returns on these bonds that Meta and Co. issue today.
That was Joachim Klement of Panmure Liberum. Don't forget, you can watch more videos on Reuters.com.